Underfunding versus overfunding a business. Introduction. Business A, Business B and Business C were having coffee after attending an entrepreneurship seminar. The speaker had just finished saying, one of the biggest reasons businesses fail is because of money. As they walked out, Business A nodded in agreement. Business A, I completely agree. If my business had more capital, I'm sure we'd be much bigger today. Business B smiled and shook their head. Business B, that's interesting, because my business almost failed after receiving a huge investment. Business C looked surprised. Business C, hold on, are you saying a business can actually have too much money? Business B replied, absolutely. Sometimes too little money is dangerous, but too much money can be just as dangerous. Business A frowned. How is that even possible? Isn't more money always better for a business? Business C leaned forward, equally curious. At first glance, the answer seems obvious. Every entrepreneur dreams of having more capital. Every startup pitches investors hoping to raise more money. Every business owner believes that a larger bank balance will solve most of their problems. But what if one of the biggest financial mistakes isn't having too little money, it's having more money than your business is actually ready to manage? Let's explore the difference between underfunding and overfunding, and why both can quietly destroy a business. What is underfunding? Underfunding occurs when a business does not have enough financial resources to support its day-to-day operations, invest in growth, or survive unexpected challenges. Think of it like trying to drive a car with only enough fuel to reach the next petrol station. Every journey becomes stressful because you're constantly worried about running out. Businesses that are underfunded often spend more time solving cash flow problems than serving customers or improving their products. Signs a business is underfunded. Business A began describing their situation. Every month feels like a race against time. Their business experienced problems such as running out of stock before new inventory could be purchased, delaying employee salaries due to cash shortages, canceling marketing campaigns because there wasn't enough budget, turning down opportunities simply because there wasn't enough working capital. The business wasn't failing because demand was low. It was struggling because it lacked the resources to support its own growth. What is overfunding? Business B then shared a very different experience. When investors gave us a large amount of money, we thought every problem could be solved by spending. Suddenly, they rented a much larger office, hired employees they didn't immediately need, purchased expensive equipment that remained unused, increased advertising without measuring whether it generated sales. The company looked successful from the outside. But inside, money was disappearing faster than the business was creating value. Overfunding doesn't mean having too much money. It means having more capital than the business can manage wisely at its current stage. Signs a business is overfunded. Business B admitted that the extra money created a false sense of security. Instead of making disciplined decisions, the business began making comfortable decisions. Common signs include expanding before demand exists, hiring based on optimism instead of workload, buying expensive tools that are rarely used, increasing operating expenses without increasing revenue, ignoring profitability because there is still cash available. Having plenty of money can sometimes hide poor financial discipline until the money runs out. Comparing the two. Business C paused for a moment before saying, so both businesses had money problems, just in completely different ways. Exactly. Business A lacked the resources needed to grow. Business B had the resources but lacked the discipline to use them effectively. One business was constantly asking, how can we survive? The other was asking, what else can we spend money on? Different situations. The same destination if left unchecked. Financial strain. Slower growth. And eventually, business failure. Finding the right balance. Business C finally understood the lesson. So success isn't about raising the biggest investment or operating with the smallest budget. Business B nodded. Exactly. The goal is to have enough funding to operate efficiently while maintaining the discipline to spend every shilling wisely. Healthy businesses don't chase money for the sake of having money. They raise capital with a clear purpose. Every investment should solve a real problem, improve efficiency, or create measurable growth. Money is a powerful business tool. But like any powerful tool, using too little, or too much, can lead to costly mistakes. Conclusion. As the conversation came to an end, Business A smiled. I walked into this discussion believing every business problem could be solved by finding more money. Business B replied, and I learned that having more money doesn't automatically make a business healthier. Business C finished the conversation with one final thought. The smartest businesses aren't the ones with the biggest bank accounts, they're the ones that know exactly how much funding they need and how to use it wisely. Because in business, success isn't determined by how much money you raise. It's determined by how effectively you manage the money you already have. Infographic summary: Underfunding versus overfunding a business. At first glance, it may seem that every business problem can be solved by raising more money. However, this infographic demonstrates that both having too little capital and having too much capital can negatively impact a business if not managed wisely. Underfunding. A business is underfunded when it lacks sufficient financial resources to operate efficiently and support growth. This often results in cash flow problems, delayed operations, missed opportunities, and difficulty meeting daily business obligations. Instead of focusing on innovation and expansion, the business spends most of its time trying to survive. Overfunding. Overfunding occurs when a business has more capital than it can effectively manage. Rather than encouraging smart investments, excess funds can lead to unnecessary spending, premature expansion, overhiring, and poor financial discipline. While the business may appear successful externally, inefficient use of capital can eventually create financial instability. The key difference. Although underfunded and overfunded businesses face different challenges, both can experience similar outcomes, including slower growth, financial strain, reduced profitability, and ultimately business failure. The right balance. The objective is not to raise the largest amount of capital or operate with the smallest budget. Successful businesses secure the right amount of funding for their current stage and manage it responsibly. Every financial decision should contribute to measurable value, improved efficiency, and sustainable growth. Key takeaway. Business success is not determined by how much money you raise, it is determined by how effectively you manage the money you have. The businesses that thrive are those that balance adequate funding with sound financial discipline, ensuring that every investment supports long-term growth and sustainability.